We are covering these 8 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on SMCI. Supermicro Computer Incorporated has been making waves recently, with some exciting announcements that are shaking up its stock performance. If you're not familiar with the company, Supermicro is a total IT solution provider that focuses on accelerated compute platforms. Their tech is used across various industries, from enterprise data centers to artificial intelligence, AI, and 5G, making them a key player in the ever-growing tech space. So what's going on now? Well, Supermicro's stock is up, thanks to its big presence at NVIDIA's GTC 2025 event. This event is where NVIDIA shows off some of the latest breakthroughs in AI, and Supermicro took full advantage of the spotlight. They made several product announcements that have investors paying attention. One of the standout announcements was Supermicro's new support for NVIDIA's RTX Pro 6000 Blackwell Server Edition GPUs. These GPUs will be integrated into a range of Supermicro's GPU servers and workstations. This is a big deal for enterprises that want to leverage accelerated computing for tasks like large language model, LLM, inference, agentic AI, visualization, and even virtual reality. Supermicro's move here is designed to broaden the accessibility of high-performance computing, which is crucial as AI continues to expand. But that's not all. The company also revealed new AI systems powered by NVIDIA's Blackwell Ultra platform, designed to push performance for AI workloads even further. What's even more interesting is that these solutions are cutting-edge not just in terms of power, but also in sustainability. Supermicro highlighted how these systems reduce power consumption by up to 40%, which helps enterprises lower costs and be more eco-friendly, something that's becoming increasingly important in today's market. On top of that, Supermicro rolled out a new optimized storage server tailored for high-performance AI and machine learning (ML) workloads, which is crucial for everything from analytics to enterprise storage. They've partnered with NVIDIA and Weka to build out these power-efficient storage systems, which will be key for building AI factories that require massive amounts of storage. All these moves are positioning Supermicro as a leader in AI and tech infrastructure. Their focus on innovation, combined with their environmental benefits and operational cost savings, is likely to attract a lot of attention from enterprises looking to scale their AI capabilities. Investors will want to keep a close eye on how these developments play out, as they signal a promising future for the company in a rapidly growing sector. Our review on HOOD. Robinhood Markets Incorporated is a financial services platform that has made waves by democratizing access to the world of investing. With a focus on making financial tools available to everyone, regardless of income, background, or wealth. Robinhood offers everything from commission-free stock and options trading to cryptocurrency transactions, as well as services like Robinhood Gold and its credit card. It's all about using technology to make the financial system more accessible, which is something that resonates with a lot of people, especially those looking to take control of their financial future without all the traditional barriers. Now, looking at Robinhood's stock performance, there's something really interesting happening. Last week, the stock surged by 10%, outpacing the broader market. While the Dow Jones, S&P 500, and Nasdaq all saw gains, Robinhood's rally stands out. This kind of price movement doesn't happen in a vacuum, and it's likely tied to investor sentiment ahead of the Federal Reserve's upcoming policy statement. With the market awaiting key updates from the Fed, there's a sense of anticipation that has investors feeling more confident in stocks like Robinhood. This jump in Robinhood stock is indicative of a few things. First, despite the overall economic uncertainty, like fluctuating performances in other tech and consumer-related stocks, including companies like Tesla and General Mills, investors are still showing confidence in Robinhood. There seems to be this growing belief that Robinhood has positioned itself well within the financial services sector, especially when it comes to appealing to a younger, tech-savvy audience that wants more control over their finances. But there's more to it. Robinhood's surge also aligns with the broader anticipation of potential regulatory or strategic updates. Investors are curious about how Robinhood plans to continue evolving in this fast-moving financial landscape. And there's a good chance that this optimism is tied to expectations of further growth. As people wait to hear the Federal Reserve's economic forecasts and how they might impact interest rates, Robinhood stock seems to be riding the wave of positive sentiment, betting that the platform's innovative offerings and its ability to adapt to market shifts will keep it on the right track. What's worth noting is how Robinhood's recent rally contrasts with some of the mixed performances we've seen in other sectors. The company's ability to hold its ground amidst broader economic concerns is a positive sign, especially for investors looking for stability and growth in a volatile market. This 10% increase in stock price reflects investor confidence in Robinhood's operational strategy, and it suggests that the market might believe in Robinhood's potential to keep growing and thriving, even as the financial world continues to change. For investors, this could be a signal that Robinhood is one to watch closely, especially if the Fed's moves in the coming weeks provide more clarity on the overall economic landscape. It'll be interesting to see how the stock performs if those expectations align with what investors are hoping for. But for now, Robinhood seems to be riding high on the momentum of its unique position in the market and its continued push toward innovation in the financial services space. Our review on SOFI. SoFi Technologies Incorporated has been making some serious moves lately, positioning itself as a major player in the financial services space. If you're not familiar, SoFi offers a wide range of products, everything from personal loans to investment tools, and even services like insurance and credit cards. The company operates through three segments: lending, technology platform, and financial services. With such a diverse set of offerings, SoFi has been working to build a platform that allows its members to borrow, save, spend, invest, and protect their money all in one place. Now, let's talk about what's been going on with SoFi stock. Over the past week, the stock shot up by 10%, which is a pretty significant jump. What's behind that surge? Well, the big catalyst seems to be SoFi finalizing a massive deal with Blue Owl Capital, an agreement for a $5 billion loan platform business. This marks SoFi's largest deal in its loan platform business so far, and it's a big step in expanding their personal loan offerings. What's really interesting about this deal is that it's part of SoFi's shift towards less capital-intensive, fee-based income streams. Instead of just relying on interest from loans, this agreement could help SoFi generate more stable revenue from fees, which is important in a market that's still dealing with economic uncertainty. This kind of move makes the company less dependent on the highs and lows of interest rate fluctuations, which is a smart play, especially given the volatility in today's market. Speaking of volatility, it's worth noting that SoFi's stock increase comes at a time when the broader market has been struggling a bit. Major indices like the Dow Jones, S&P 500, and NASDAQ have all been under pressure, mainly due to concerns about tariffs and the possibility of a recession. Technology stocks have taken a hit in particular. Companies like Tesla have seen substantial declines. But despite these headwinds, SoFi's stock has shown resilience, and that could be largely due to this strategic move with Blue Owl Capital. So, what does this mean for investors? Well, SoFi is showing that it's not just weathering the storm, but actively adapting to it. By expanding into personal loans and moving toward more fee-based income, SoFi is positioning itself for long-term growth, even if the broader market faces challenges. This partnership with Blue Owl could be a key step in building a more stable and diversified revenue stream, which might give investors more confidence in the company's ability to navigate through uncertain times. If you're watching SoFi, it's definitely worth keeping an eye on how this deal plays out, as it could set the tone for the company's next phase of growth. Our review on WULF. TeraWulf Incorporated is doing some pretty unique things in the data center world, especially with its focus on sustainable Bitcoin, mining, and high-performance computing. They run their Lake Mariner facility in western New York, which is built on the site of an old coal power plant. What really sets TeraWulf apart is their use of clean energy, nuclear and hydroelectric power, to fuel their operations. Their whole mission is to lead the energy transition by making Bitcoin mining and AI applications more eco-friendly. Recently, TeraWulf stock has been on the rise, and a lot of that is thanks to this eco-friendly approach. With Bitcoin mining and AI computing both growing rapidly, investors are taking notice of TeraWulf's ability to scale its operations while keeping its environmental impact low. As sustainability becomes a bigger deal across industries, the company's use of clean, zero-carbon energy is definitely resonating with people. For investors, TeraWulf presents a strong growth opportunity. They're tapping into the expanding crypto and AI markets while also positioning themselves as a leader in sustainable energy use. If they can keep ramping up their mining capacity and continue to use clean energy efficiently, they could see long-term success. It's a solid bet for anyone interested in companies that are innovating with both green energy and emerging tech. Definitely one to watch as these trends keep growing. Our review on CLSK. CleanSpark Incorporated is a Bitcoin mining company that's been steadily growing its footprint across the United States. With data centers located in Georgia, Mississippi, Tennessee, and Wyoming, the company currently has a total contracted power capacity of about 853 megawatts. They've designed their infrastructure to be both efficient and responsible, with the aim of securing the Bitcoin network in a sustainable way. As of now, CleanSpark operates over 188,000 mining machines and is capable of producing more than 40 exahashes per second of computing power. Not too shabby. Recently, CleanSpark stock has been moving upward, and a lot of that can be traced to some smart moves the company's been making. First off, CleanSpark's ability to scale its operations with such a massive fleet of mining machines is impressive. They're also managing to maintain a fleet-wide efficiency of just 21.94 joules per terahash, which puts them in a strong position for cost-effective mining, especially as the industry gets more competitive. The company's been pretty strategic about expansion, too, by tapping into various states and securing multiple data centers. CleanSpark is positioning itself well in terms of both capacity and geographical reach. This type of growth not only gives them more mining power, but also helps hedge against energy costs and other market fluctuations that can affect mining operations. For investors, CleanSpark represents a solid play in the Bitcoin mining space. With their efficient operations and ongoing expansion, the company seems to be on a good path for sustainable growth. If they continue to scale their operations while keeping costs low, it could lead to some nice returns down the line. Given the volatility of the crypto market, there's still a level of risk, but CleanSpark's solid infrastructure and efficiency make it an intriguing option in the Bitcoin mining sector. Keep an eye on them as the industry continues to evolve. Our review on STNE. StoneCo Ltd is one of those financial tech companies that really makes life easier for small and medium businesses. They offer a cloud-based platform packed with tools like payments, digital banking, credit solutions, and even software to manage things like point of sale, POS, systems, and customer relationships. The goal is to help businesses run smoother and grow, all while offering features like split payment processing and easy one-click buying for customers. When it comes to their recent earnings, StoneCo delivered a solid performance. They reported adjusted earnings of 2.26 Brazilian reals per share, which beat the expected 1.95 Brazilian reals by about 16%. That's a pretty strong year-over-year increase of 25.56% from the 1.80 Brazilian reals per share they made in the same quarter last year. On top of that, their sales came in at 3.609 billion Brazilian reals, just beating the estimate of 3.591 billion Brazilian reals by a small margin, but still reflecting an 11% growth from the previous year. For investors, this is a great sign. StoneCo is not just meeting expectations, but beating them and showing steady growth in both revenue and earnings. This kind of performance is a good indicator that they're executing their strategy well and continuing to attract more businesses to their platform. If they keep this momentum going, they could be in a strong position for the future. Definitely one to keep an eye on, especially as they keep rolling out new features for SMBs. Our review on HIMS. HIMS and Hers Health Incorporated is really making waves in the healthcare space with its consumer-focused digital platform. They're all about simplifying access to health and wellness services, whether it's sexual health, dermatology, mental health, or weight loss. Their platform connects you with licensed healthcare professionals who can prescribe medications when needed, and everything is done through their mobile app. From digital prescriptions to wellness products, they're bringing healthcare to your fingertips in a way that's both convenient and discreet. Looking at the company's recent growth, it's easy to see why investors are paying attention. As telehealth and digital healthcare have really taken off, especially post-pandemic, HIMS and Hers has positioned itself as a leader in the space. They've been expanding their services, making it easier for people to access the care they need without leaving home, and the demand for that kind of convenience just keeps growing. Plus, they're offering a range of curated prescription and non-prescription products that cater to individual needs, which only adds more value to what they're offering. For investors, HIMS and Hers is looking pretty solid. With the healthcare world moving more and more toward digital-first solutions, they're in a great position to continue growing. The company's ability to scale and attract new customers is clear, and with the ongoing shift in how people approach healthcare, HIMS and Hers could see sustained success in the future. It's definitely a company to watch, especially as more people turn to digital platforms for their health and wellness needs. If they continue to innovate and meet the growing demand for accessible healthcare, their stock could keep climbing. Our review on BA. The Boeing Company is an aerospace giant that operates in several key sectors: commercial airplanes, defense, space, and global services. Its commercial aircraft division develops and manufactures some of the most widely used jets in the world, like the 737, 767, 777, and 787. Meanwhile, their defense and space sectors focus on military aircraft and weapons systems, and their global services arm provides support for aerospace platforms through maintenance, upgrades, and technical services. Now, let's talk about the recent movement in Boeing stock. It's been climbing, and a lot of that has to do with some upbeat news coming out of their investor conference. Boeing's CFO, Brian West, shared some encouraging news about the company's financial health, saying the company's cash burn is easing up, which is a major positive after some of the struggles Boeing faced in the past couple of years. Not only that, but they're expecting to deliver more planes than originally forecasted, which suggests strong demand and operational improvements. West even estimated that this reduction in cash burn could be in the hundreds of millions of dollars, which is definitely a good sign for investors. On top of that, Boeing has already made progress in terms of deliveries, with 44 jets shipped in February, a nice jump from the 27 delivered during the same month last year. The company is sticking to its goal of delivering 38 jets per month, and it doesn't expect any major disruptions from supply chain issues or tariffs in the near term. The outlook is looking pretty solid, especially with Boeing's large backlog of orders and the continued demand for its aircraft, like the 737 MAX. For investors, this is a promising update. Boeing seems to be getting back on track, with improvements in its cash flow and production. The stock's movement is reflecting that optimism, and with the company positioned well in both commercial and defense sectors, there could be more growth on the horizon. Keep an eye on Boeing as they continue to deliver more planes and manage their cash burn. If they keep up this momentum, the stock might keep rising. Please subscribe, give the video a like, and watch more from our playlist. Thanks.